All right, so the topic of today's presentation is how did we go about building a brand new strategy, primarily in a new regime, a new asset class called foreign exchange. How many of you guys deal with active trading of some sort, whether it's foreign exchange or just equities? How many actually have done foreign exchange trading? There's quite a few hands. Actually, I'm impressed. So we're going to cover some topics that may be trivial for some of you. Just bear with us. It'll get more and more interesting as we go through this presentation. So hopefully you'll all get something out of it. We'll talk more about machine learning approaches and algorithmic approaches to investment in the context of building a new strategy using big data analytics. So stick around. Hopefully you'll get something out of it. Before we start with the actual presentation, I want to tell you more about Lucena and who we are. We are a 3.5-year-old fintech company out of Atlanta, Georgia. We are a spin-off of Georgia Tech. Our expertise really lies in the realm of machine learning application to big data analytics in the context of investment. We empower basically wealth managers, hedge funds, and other portfolio managers with the capabilities to take advantage of big data and predictive analytics. The concept here is essentially allowing people to apply scientific approach to their investment decisions, right? So beyond your fundamental research, your insight, your hunch, and your gut feeling, we have an overlay decision processing methodology to take big data into account and apply it to investment. So that's kind of where we are. How do we do it? We aggregate lots and lots of data, not like Splunk. They are one step above us as far as the size of the data. But we have terabytes of data that's specifically designed for financial investment, right? So essentially we take technical data, anything from moving averages and stochastics of the likes and the Bollinger Bands. We also capture fundamental data in the concept of balance sheet and revenue reporting type of information. And we have many other data sources, microecon, newsfeed, sentiment analysis, social media, sentiment analysis, and many, many others. We take them all into one huge database, and we apply machine learning to allow people to consume that intelligence into the decision making. We have 3 offerings. Quantitative is just our base product. And we have some strategies that we design to enable our customers to see the value of our offerings, but also to be able to consume them by subscribing to them. Just to give you an idea of what we provide, long-short equity, short-term kind of rebalanced long-short market neutral strategies. We have Wave Rider, which is a sector rotation strategy. We have risk parity, and we have a whole bunch of others. And today we'll talk about the FRX, which is a foreign exchange active strategy. And we always, of course, innovate and try to find new ideas, new technologies. Okay, so we designed in Lucena to scale our business model a very regimented process by which we go after building a new strategy. The idea is that before we get into the actual construction of the strategy, we have to come up with some kind of a human insight that put together an idea that we find suitable to take the next step and dig a little deeper. We then basically try to automate some of the idea as far as code-wise. We try to automate the process of how we see the algorithm kind of act upon the data that we have in our database, identify, of course, new sources of data and how they're going to be consumed by our platform. And then, of course, we conduct an in-sample testing, which means we actually evaluate how the algorithm works, knowing what the future holds and verifying that it is actually predictive when compared to what the outcome actually was by rolling back time and evaluating how it had performed to expectations. And of course, once we come up with something suitable, we try to test out of sample, which is a period of time in the past that have no knowledge of what is about to take place, testing out of sample. And of course, verifying that it works well. But again, the big test is really forward testing, paper trading, and it's all done in our platform without writing a single line of code. It's all fully automated. And we're very proud of what we had built there. Of course, once it's all passing all these litmus tests, we go into live trading and start with small capital deployment and expand rapidly thereafter if it becomes successful. That's kind of the notion of what we do to build a new strategy. So, now that you know what we do, let's talk about foreign exchange. So I don't know if you know the FX market is or FRX, it's all synonymous to foreign exchange currency trading. It's the most liquid market in the world, right? So we have $5.3 trillion a day changing hands in that market. What's good about it is basically it's very hard to manipulate that market through large transactions. Just in comparison to equities, it's about $2.2 trillion of volume exchanges per day on the equity side. But it is broken across 10,000 or so securities around the world. In foreign exchange, the G10 is 10 currencies. The currencies are traded as pairs, so you have basically 90 pairs as far as the universe of potential trades if you're doing a spot trading, which is basically what we have advocated in this strategy. So much smaller universe, large quantity of inventory, which is, of course, in size, and very liquid. And it's very hard to manipulate, but it's exciting. It's 24/7, 5.5 days a week. It is open, so it provides interesting, exciting opportunities for individual investors that historically were not able to do that because it used to be only open to large banks. But now with the whole evolution of the internet and platforms, it becomes more ubiquitous in recent years. Essentially, the way we interestingly enough, the leverage of foreign exchange is by far larger than any other market in the world. You can actually extend your reach as far as your money that you deploy to foreign exchange strategy up to 250 times. I think you'll be insane to do that because if you lose 1 cent, you lost the entire portfolio. But the concept of leverage is much more easily achievable through foreign exchange. It's cheaper to borrow money, and many people take advantage of it. 10x, 50x, not so much 250, but it is possible if somebody wants to go crazy. We actually spend our research on the G10, which is the 10 largest countries from an economic perspective, because we want to make sure we are going with a stable and trustworthy type of currency where the treasuries are being protected fairly well by the government that issues them. And obviously, there are other types of regimes that you want to maybe take a look at, such as the ruble in Russia and maybe emerging markets. We kind of shied away from that in this particular strategy. By the way, if anybody has any questions, let's kind of stop. I'm going to stop periodically to see if any questions. We can talk through it and then move on to the next slide. So any questions so far? Good. All right, so this is an interesting chart. What we have done here is we have taken the price history, daily value, of each one of the currencies in the G10. So there's 10 graphs here that represents the price volatility of movements on a day-by-day basis between January 1st, 2008 through March 31st, 2016. And the whole idea here is to come up with a concept of how do we look at this market and what are the opportunities. What you see here is actually very interesting. If I had to look at a similar chart that represents equities in the US, for example, from 2008 to 2016, what would the average line would look like? That's correct. It's going to go up with some volatility, but for the most part, it'll go up over a period of time. That tells you that if you have a buy and hold strategy with equities, it may actually be a pretty wise thing to do. Over time, you'll make money. In foreign exchange, it's a little bit more flat, right? You have a lot of volatility here, a lot of movement. It's not really a very clear directional kind of price move. And that screams, in our opinion, an opportunity to leverage inefficiencies between multiple constituents. In other words, going with a pair trading concept, going with longing potentially one constituent against shorting another one. It also talks about timing of investment decision and short-term accrual of revenue. So you basically find opportunities, you get in, you stay for a little bit of time to gain the maximum potential from that investment, and you check out to find something else. And if I have to superimpose our back test of our final strategy on top of what you see here, it would look like that. This is the actual line that represents a back test of Lucena's foreign exchange strategy for the same period. And you can see we were able to leverage with some volatility, but still leverage the ability to come in and out in periods of time and over time accrue return for that regime. Okay, so how did we do it? What did we do to build the strategy? And how did we apply machine learning capabilities to support that? So here's what we do in our strategy. The FRX, we call it FRX, very innovative name. I apologize. But the idea is to take a daily allocation of 5% of your available capacity, or the NAV of your portfolio, and allocate every day 5% towards the appropriate constituents that came on the radar. You equally allocate your available cash between those constituents, up to 5, and you hold them for 21 days. So day 1, you have 5% allocation. Day 2, you have 10%. Day 3, 15. On and on through day 20, you are fully allocated. If nothing else came out early, which we can have early exits, I'll talk about that in a second, and you would actually be fully allocated. Day 21, the first constituents come out, and new ones are coming in. So you are rotating these pairs continuously throughout the entire operating time frame of the strategy. Now, we advocate pairs trading because we want to go with a currency pair, which essentially, behind the scene, you are bullish one currency against bearish on another currency, and the difference between the two valuations over time, as it grows or shrinks, creates that opportunity for income. Okay. How do we identify constituents that are going to match the criteria to choose from the 90 pairs? We want to pick up to 5 pairs. Maybe there'll be 1 or 2 or nothing. But how do we identify a qualified foreign exchange currency trade that is most meaningful and most appropriate to move higher together at any given time? So we use something called event scan, and I'll explain that in a second. Now, these event scans use factors. We have about 450 factors in our database that describe any security, equity, but also foreign exchange pairs. And we can identify over time which factors can be more meaningful to identify a pair as a good time to enter, like a signal-based kind of identification through a scan or event study technology. And I'll explain what it is in a second. We also assess 2 types of factors to identify foreign exchange trades. We look at macroeconomic factors, and we superimpose them with some technical factors. So we look at the long-term and short-term signals. Long-term signal in connection and in conjunction with a short-term technical momentum shift or mean reversion that we try to identify on those very same constituents. When the stars line up perfectly on the long-term evaluation and on the short-term evaluation, we think it's a good, clear signal to enter that position at that given time. So how do we go about finding these potential opportunities? Through machine learning and big data analytics. Let me talk about some of the techniques here. So obviously, it all starts with human insight. We advocate that human insight will be critical, number one, to identify the opportunity, right? So just looking at charts and thinking about, okay, how do I make some sense out of it? But more importantly, human insight can also be used to overrule what the machine recommends to us. We don't necessarily advocate that it'll be always algorithmically driven. For the most part, it will, maybe 99%. But I want to give a chance to the human being to say, you know what? I want to put a stop to it. For example, we have a big vote happening in Europe very soon. You guys heard about the Brexit? British pound exiting the euro? If you think about the ramification of this event could be devastating for a portfolio manager that manages currencies. Maybe it's time for us to say, you know what? Take the British pound out of the portfolio until the vote is finished. Because these are events that are not meaningful enough to apply machine learning to because they're so seldomly taking place, right? So essentially, we have the ability to overrule what the machine recommends. But for the most part, it will be completely algorithmic. Global macro features, technical features, price history. We look at spot prices. This is just, there's three ways to invest in currencies. There's spot rates, which is the most popular one. There's also futures and contracts. I'm not going to touch that today. It's a little bit more involved. And we actually stayed at the spot price level. And of course, we apply machine learning. Think about decision trees, Cadane methods, forward and backwards algorithms, and brute force search, and many others that Tucker will talk more about specifically. Okay. Let me explain the concept of event study. So everybody knows what a scan is, or what a filter is. You have a universe of potential constituents. You apply some criteria that a value has to be between a min value and a max value. You scan, and you get the results. So what you see on the screen here is a bunch of equities. I'm applying some sort of a factor search, which is a sharp ratio between some number and another number. And the days in which that scan match the criteria, or one stock, let's say Apple, match the criteria, I can identify on that day what happened to Apple before and what happened to it after. Now, why is it important? Because if I can evaluate how predictive a scan is, for example, people know about golden cross or death cross. This is when two moving averages, technical feature, crossing each other. For many, many years, a 200-day moving average being crossed by a 100-day moving average indicate we call a golden cross, which is basically a bullish movement of a stock. Why? Because the slower moving average, the faster moving average is crossing to the upside ahead of the slower moving average. Now, how do you know if it's really predictive? What you can do is go back in time and run a scenario by which show me how many times a stock hit its 20-day moving average and what happened to that stock before it hit that moving average and after. I can do it over time, every day, through history, and aggregate the information as to see if there's any repeatability or a trend in that behavior. So I can see that you can do the same scans over time in the past, identify what happened before or after the event took place, and then put it all together in aggregate and identify, is this really a repeatable event that shows consistency over time in history that I can make some assumption that you'll do the same in the future. This is what an event study is. I can take all these small events, put them together, show the mean and the first standard deviation, and I can draw an event chart that shows the distribution of price action after the event took place. And what you see here is actually the end result of an event scan that shows all these movements before and after. This is the event date. This is before. This is the after. First standard deviation, half standard deviation, and the mean. Any questions so far? Okay, good. You guys are smart. Yes?
What if everybody will use this strategy? What will happen there?
Very good question. So the question was, what if everybody did the exact same thing? What would happen to the strategy? That's correct. It'll be fully exploited and it will not work. But here's the issue that you have to realize here. There are 450 factors. The amount of combination you can possibly have is 450 factorial. It's a number with thousands of digits. There is endless opportunities. Not to mention that each factor can actually have enormous number of min-max thresholds. So there's really a very, very large potential combination that can work. But also, we limit the exposure of these technologies to only few people that consume our strategy. So we have capacity limitation of what we can actually allow others to have versus the whole world, right? So that's the idea. But if you subscribe to the platform and you can just build your own, that would be the way to do it. That would be one way of doing it. We have about 5 other, of course, methods to building predictive analytics technologies. So, putting it all together, here is the interesting part. The problem I just told you before, there's 450 factors, so many possibilities. How do we know what works with what? I can go by myself and try every one of those combinations by hand. I'll be probably dead by the time I got to a very small portion of the possible permutations. So we can use machine learning approach to help us get there more efficiently and more accurately. And I'll let Tucker talk about these techniques that we use to do exactly that.
Hey, he didn't introduce himself. This is Erez Katz, our CEO.
Oh, I apologize. Thank you.
Anyways, he'll be back up here again shortly. I'm Tucker Balch. I'm the chief scientist of Lucena, and we're here representing Lucena Research. Also, one of our board members, Bruce Fike, is here. Raise your hand, Bruce. Anyways, thanks again also for having us. One thing I want to say is I estimate about, so there's 2 parts of the talk. We've seen a bit of the finance part. Now we're going to launch into the machine learning part. And about half of you are going to have been disappointed in the finance part. And now the other half are going to be disappointed in the machine learning part. But hopefully everybody comes away with something. What I mean by that is if you're already an expert Forex trader, you probably knew a lot about what Erez said. If you're a deeply experienced machine learning person, I'm going to tell you about some stuff that maybe you already know, but hopefully you'll come away seeing how you can put those 2 things together. So before I launch into my part, who has worked with decision trees before? Okay, it's going to be a tough crowd for me. But bear with me. So as probably most of you all know, really big data, data analytics, machine learning, it's really all the same thing, right? We give it different names as time goes forward. Actually, statisticians say it's statistics, and that they thought of it first. Is anybody in here a statistician? Yeah, okay, there you go. Right, you came up, this is all old stuff, right? Anyways, we're going to focus on supervised learning. There's many flavors of machine learning, of course. Supervised is where you give the system some factors that you measure and an outcome, and many, many examples of that. And the reason it's called supervised is because you're giving it the right answer. Other forms of machine learning are things like clustering and, of course, unsupervised learning. So here's a general process we take. You start with lots and lots of data, of course, and we break it into 2 parts. I call it X and Y. X are the factors that you're evaluating. Y is the outcome. So in the context of stocks, the X component are the factors relating to stocks. It might be price-earnings ratio. It might be momentum, numbers that you can measure on those stocks. Y is typically the how much the stock goes up or down into the future. Now, when you go back in time, you know what the values of these features were on a particular date, but you can also peek forward and see how the price changed. So you have access to this data. Now today, of course, we don't know what's going to happen in 21 days, so we have to train the system on historical data. These sorts of approaches, I missed the step here. So the magic happens in this little box. If you can master that little box, machine learning, you can solve any problem. Anyways, what you want to end up with is a model, and that's a fancy term for you can measure these factors and plop out a y, which is a prediction. Now, there's many different kinds of models, right? So they can be based on decision trees. They could be based on neural networks. They could even be parametric. There could be an underlying polynomial, as opposed to keeping all the data around, which most of these methods use. You can actually build a model that's just an equation. We focus on these non-parametric models like k-nearest neighbor and decision trees because they can, because they are nonlinear. They can work in situations where there isn't just a linear relationship between the factors and the prediction. So I'm going to dig into decision trees, which is what we're using for this Forex strategy. Now, a couple weeks ago, when I was looking for some inspiration about how to give an interesting talk about decision trees, this meme came on my Facebook page. And it's basically a way to tell you who you ought to vote for. I'll leave it up there for a moment. This is a decision tree. Now, it's a little bit rude, okay? I apologize for the rudeness. But it starts with, is shit broken? No, you come down over here, and then you've got a choice between, let's clean it up a little bit and pose it as a machine learning problem. So suppose we wanted to build a way to predict who someone's going to vote for. Well, we would come up with a few questions that we would ask them. These are, you notice they're sort of true-false questions. We'd go out and ask a couple thousand people these questions. That's our X. And then we'd ask them, okay, who are you going to vote for? That's our Y. So we have now data that we can use to build a supervised learner. We have these X factors and the Y outcome factors. And if we were to build a tree like that meme I showed you, this is what it looks like when it's de-offensified and cleaned up a little bit. It's basically a flow chart where at each one of these nodes you ask a true-false question and you follow it down one path or another. And it's a tree in the sense that it has a root here and then leaves. It turns out to be upside-down tree. But you started this first question. If the answer is yes, you come down here. And then when you reach a leaf, that's your answer. So that's how to use a decision tree if you have one. And in this case, it's applied to predicting who you might vote for. Well, we can do the same thing with stock factors. And instead of predicting who someone might vote for, we can make a classification as to whether we think a particular asset is going to go up or down. So instead of asking questions about, is stuff broken, we ask quantitative questions regarding metrics of stocks or whatever asset you're tracking. And then you just follow it down and you get to a forecast or prediction. Now, this is the use of decision trees for classification. You can also use it for regression, which means instead of identifying it as something that's going to go up or down, you have an actual number representing a prediction of how much it's going to go up or down. Now, we've seen in our practice that our learners are more productive for us if we go the classification route than the regression route. And in fact, this Forex strategy uses the classification approach instead of the regression approach. And we'll return to that in a little bit. So this is, if you have a tree, how you can use it. Now I'm going to just cover one slide of, how do you build a tree in the first place? So you start with your data. And, we've got several. We can, in our case, we have up to 400 X's, which means our data, is a 400-dimensional system, and usually just one Y, which is the outcome. Now, a beautiful thing about decision trees is you can end up with a decision tree that gives you decent answers that doesn't use all of the factors that you have. In fact, decision tree building methods end up selecting which features really matter. So even though you might start with 400, you might end up only using a handful of those features in your approach. Anyways, we start not just with one set of x's and y's, but thousands or millions of them, and then we build our tree in the following way. First, we look at all this data and we find what is the most predictive of these factors, and that becomes the root of our tree. So how do you decide which one is the most predictive? A typical technique is you look at each one of these factors one at a time and see how well correlated it is with your outcome. One of them is going to be the most correlated, and that one then naturally becomes the root of your tree. You then divide your data in half according to that factor, and now you've got the source data for each path down the rest of your tree, and you just repeat that process to build your tree. Okay, so that's, yeah.
So there's 450 factors. So do you have all 450 factors when you're using the tree? Don't you have to prune it before?
So so I'll repeat the question for those who are listening out in the internet world. The question was, if there's 450 factors, do you use all of them in a tree? So there's two answers to that question. The first one is this method of selecting the most predictive factor, which you do at each level, ends up usually not selecting all of the factors in your database. It finds the ones that are most selective. Now it turns out that most of the factors have very minimal correlation with the actual outcome. In fact, if you're an engineer, when you're looking for factors that matter, you're probably used to seeing correlations like 0.8 or something with between your x's and your y's. It turns out that in machine learning based trading, you can fairly often, well, better than 50%, predict a future price with only a 0.08 correlation. You can't make money with that because just through the act of trading, you'll impact the price enough that it becomes useless. However, if you have a correlation of 0.12, you can actually make money. So there's there's very little information in this data, but with a little bit, you can make a profit. Now, when we combine these factors together, when we've got multiple factors, we end up having a slightly higher correlation, with what we predict and what actually happens. Anyways, in the end, our trees don't include 400 factors. First, because of the way that we select them here, but also we go through another process that Erez is going to show later, where we ask our system to find the most predictive factors one at a time. So we find first the most predictive, then the next one, and we combine them. Then we end up with maybe 7 to 10, and we use only those factors to build our tree. Anyways, a question in the back there.
Something that I didn't get is, the weighing of H. Is it the machine learning problem, or is there human factor?
So so the question was, in weighting these factors, is that a machine learning problem or a human problem? And we definitely rely somewhat on human insight to help us select our factors. For instance, we feel that, there's lots of factors that we just feel obviously aren't going to influence a currency price, and we rule them out and we focus on ones that we know have a chance to work. So we start with that part of human insight. Then we unleash the machine learning to find among those remaining which ones are the most predictive. So it's a combination of the two. Now, in terms of weighting them, an interesting thing about decision trees is it sort of eliminates the need to weight factors. In the context of some others, like k nearest neighbor, you end up having to very carefully normalize your data, which is fine. I mean, we do that. but and or weight factors differently. Decision trees end up deciding that for you without you having to explicitly weight them. Yes?
I noticed that in the tree-based models you only had decision tree. Just curious, did you also look at like random forests or GBMs?
Yes, random forests are great, and I'm just showing you right now how to build one tree, but decision trees are somewhat prone to overfitting, and decision forests are a great way to reduce that propensity to overfitting. And yes, we use them, and we find them effective. Okay, let me move on. Before I go to the next slide, so I'm going to hand it over to Erez in just a moment. A couple comments I wanted to make about data, and it relates partly to that weighting question. One thing that we've discovered that's extremely valuable is instead of using factors regarding stocks, using their values directly, PE ratio is a good example. It may be that back in 1980, a certain PE ratio, that's price earnings ratio, the common evaluation of a stock, a certain range worked back then, and nowadays completely different ranges are appropriate. Right now lots of companies have insane PE ratios. I don't know what's Splunk's PE ratio. Anyways, the high-flying internet stocks typically all have very high PE ratios. Anyways, the point is that instead of just taking that number directly, what we do is we rank. So we rank all the stocks, say in the Russell 1000, according to each of these factors. So instead of just having the PE ratio number, we have the PE ratio rank. So back in 1980, maybe the bottom 10% worked well, and maybe today the bottom 10% works well. So it's a number you can use, a potential number you can use across time. Okay, I'm going to hand it back now to Erez, and he's going to show how we now utilize this decision tree approach in building the Forex strategy.
Well, thanks, Tucker. Just kind of to talk about the weights of factors, and I'm out of my league here, but in a way with random forest, we have multiple trees. You may have multiple factors being more represented by some of the trees than others, and the weighing kind of takes place on its own. I'm not sure if this is pure weighing or weighting as you were referring to it, but that's one way of having the data kind of almost drives the weighting from its own algorithmic approach. But I want to show you how it works as far as visualization. I want to go to the platform and show you in real time how do we apply the decision trees concept as to suggestive selection of which factors are going to work. So what you see on the top here, I'm going to get to the demo in a second, is basically a standard distribution, a normalized distribution of events that took place market relative in a given time. So what we've done here is basically ran an event scan that had no conditions. Basically every security in that basket that we are trying to evaluate, it captures in any day how the price moved 21 days into the future. 21 days is about 1 month of trading time. So this is kind of the time frame we're trying to concentrate on in this strategy. You see that the prices are fairly well distributed. Now what happens if I can tell the machine to give me a suggestion or a clue as to classifying which factors are most responsible or most selective to land the events on the upper half of the standard deviation of the price distribution. Now I'm going to narrow down the total number of events to only a few selected that correspond to a factor that the machine recommends and ranks it for me, using decision trees to identify the recommended factors. Let me show you how it works in real time. Hopefully, I can do it still, and I'm still connected to the internet. So let me, I need to get out of the presentation mode here. Sorry about that. Move the screen over. There you go. Okay. This is the platform. This is Quantitative, by the way. And I want to go into only one platform called the event scan. And let me try and... so this is basically, I'm looking at the foreign exchange universe. There are no conditions at this present time. I'm trying to scan and evaluate the behavior of all these constituents over a time in the past. You can see the dates that I'm looking for is January 1st, 2010 through 3/31/20. It's 1 quarter, basically, of calendar quarter. The scan is actually now looking at all the constituents that met the criteria. They found some of them. It gives you the number of how many were found. And now it's categorizing them as far as a price distribution from 1 day to 21 days into the future. When it comes back, in just a second, what you see here is a couple of things. First of all, I'm going to go to the first tab that shows you the actual constituents that met the criteria and the price change 1 day to 21 days later. On the bottom, you see the average price change, and you can see it's pretty flat. It's on a zero line. And the reason is because we have no criteria. So it's basically showing you the price distribution as a normalized Gaussian type of distribution graph. Now I'm going to push the machine learning button called Optimize and see what the machine recommends to me from the available factors that we have. We have 450 factors. We only look at certain factors, as Tucker mentioned, that are specifically applicable to foreign exchange. It's macroeconomic factors and foreign exchange technical factors that we actually made specifically for that data set. When it comes back, you can see how it ranks the factors with the stars and a number that represents the quality of each factor and what the impact that it will make on the mean line and the retention of the maximum number of events. So we rank it on 2 factors. How many events can I retain to maximize them landing on the top half that I've highlighted here? And what is the impact on the mean return if I add that factor to the scan? So let me show you how it works. I'm going to go and specifically look for factors that are macroecon. I'm sorry, I can't see from the other side, so I want to look to see which one. I'm looking for foreign exchange macroecon right there. And you can see that the first factor that was selected is a GDP percent change. Now, if I highlight the right side of the button, it will give me some more analysis as to the quality of this feature if I add it to the scan. So what you see here is the following. You see that it has a retention of 33% of the events, but the average return is going to grow from 0 to about 1%. So I want to keep about a third of my universe of events, but I'm going to increase the likelihood of success at the mean line to 1%. Let me just add that in and see what happens. So now the scan is re-energized with a new factor that qualifies the events and see what the mean return is going to be with this new factor. Now we are looking at in sample. This is January 1st through March 31st. The question is, do I get the same results out of sample? And let's see, first of all, what happens. You see now we have about a third of the events coming in. It'll sort them up and kind of catalog it for us as far as the aggregation and the summary information. And if I go down to the bottom of the screen, you'll see now that we have a much, much nicer bias to the upside. And even the third level of standard deviation, you have, from this is the 0 line, this is infinity. But even the half bottom is kind of going flat to the upside towards the 0 line. So we have a very good chance that if we apply this factor during that time, even randomly after we apply this pre-search mechanism, we have a 2/3 chance of being successful in making money if we held that stock or that position, the currency position, for 21 days. Now the question is, does it really stick out of sample? So I'm going to go out of sample. If you can see the in-sample period on top is January 1st to 3/31. What would be a good out-of-sample period? Anybody has any suggestion? I can go with April 1st through April 30th, for example, but I probably don't want to do that. I want to go to April 21st to May 30th, for example. Why April 21st? Anybody can give me any idea? Why would I want to start 21 days later? Yes?
Option expiration. Yep.
Not exactly. So I've measured the 21 days return in the in-sample period. If my last day was March 31st, I'm looking at 21 days return after March 31st. I'm already overlapping my out-of-sample period. If I want to have a pure out-of-sample measurement, I want to go after that, I would say, touched period, which is the 21 days in the beginning of that out-of-sample sort of new period, right? Because I already measured the first 21 days from the previous one-day projection on March 31st. So I want to start with April 21st through, let's say, May 30th. Let's see if I can do that. This is what the event looks like. I go to Edit. Last histogram, it shows you the distribution of, and I can't see the screen very well from here. I'm going to try and do my best to go April 21st. So it's one row below. Okay. And I'm going to do the end into May 30th. May 31st. When's December? Okay.
Why did you go all the way to May 30th?
I'm just trying to find a period of time out of sample that's short enough for us to not wait too long and show you the results. I can go any time frame. And truly, it's a good question because there is the concept of alpha decay that basically is going to, there will be a time where these conditions may not be appropriate anymore. So you want to recreate that optimization over and over again so you can be suitable for different type of conditions in the market. So it's not a one solution fits all forever. There's a time decay also on the quality of the signal that corresponds to time frames. Okay, so now we have the out of sample time frame. We can try the same exact scan now out of sample, and our hope is that it'll still stick. It'll still have some value beyond the zero line using the same exact scan conditions. We'll come back in just a second.
One thing that Erez was saying there is that it turns out that over time, the factors that matter change. Because right now we're in this situation in the U.S. where we're anticipating interest rates to go up again, and so stocks behave differently than they do when that's not on the horizon. So we're constantly evaluating which factors matter.
So the results out of sample look pretty promising. That's a good indication that what we found was not by accident. Obviously, this is very simplistic. We have to do thousands of tests to ensure that through backtest simulation, different conditions. And by the way, many of our scans are not just one factor, are multiple factors. So that's kind of how the process goes. And that's kind of in a true simplified fashion on our platform, showing you how the process kind of works. Okay. Any questions so far on what I've been showing you so far?
What's the optimum time frame that you find, and how often do you retrain?
I'm so glad you asked that question because I don't have the answer, but I'll tell you how we find the answer. So the idea behind the technology that we employ with the foreign exchange strategy is to do the exactly same process, but multiple times over and over again. You start with a clean slate, you run a scan, you highlight the area you want to concentrate in, you get recommendations of features, you add them, you get an increased probability, historically speaking. You repeat the process until you're happy with it, and you test out of sample. That's kind of the overarching process that we engage in this technology. Now the question is, what is the optimal look-back period? What is the optimal holding period? How many factors should you use? What factors should you select? And many, many other questions. And we apply some sort of a parametric or actually a grid brute force search to identify which one of these walk-forward algos is going to be most predictive over a very long time. So there's potentially thousands of combinations of parameters that we can use to identify this construct, how does it work best? And what you see here is, by the way, what we come up with. There's a 3-month long-term macroeconomic evaluation, followed by a 1-week technical factors suggestions. And once they both agree together, we basically save the event scan, and we get constituents that met the criteria on a roll-forward basis. So you can see that every day we scan, we get 2, 3, even 1, or maybe even 0 constituents. As they come on the surface, we actually make the purchase of these pairs in our trading strategy. So to your question, how do we come about to find what works, what doesn't work? So you can see what we have looked for. We look for what is the optimal look back, what is the optimal holding period, what factors should be used, how many factors, and we can use multiple time frames to define the event, long-term and short-term. This is not easy to do with a bare hand or with an uninitiated kind of technology. This is a pretty complex stuff, and that's why it's so hard. To the other question, if everybody could do it. It's not for everyone because not too many people can actually come up with that kind of sophistication to come up with a technology that can drive that kind of unique approach to investment. Okay, so let me give you a quick overview of how the strategy actually performed in our final back testing before we went live with it about 2 months ago. So it's still in testing mode on forward testing. But this is the back test from our technology, from our platform that shows you the orange is actually the actual strategy, these pair trades that actually take place every day. And what you see in blue here is a benchmark called the ICI, which is basically the IPath optimized currency trade for ETN. So it's a carry trade benchmark that we use to compare how we do against professional grade constituents that are in the currency market trading. So this is what we have. You can see that we've gotten 41% over the course of this time frame from 08 to 2016. You can see also that the results are 1x levered. So in stocks, it may not be as impressive, although it's pretty nice and steady with a 0.70 sharp over an 8-year time frame. But if you do a 5 times or 10 times leverage, the numbers add up pretty quickly, and that's the beauty of this strategy. Yes?
I don't know how to. So what I'm noticing is that since you're back testing, right? You've been running it live for under a year.
Yeah, about 2 months now.
So back testing it from 2008 till about end of 2015 is a time in the Forex markets is a time of great trading conditions because the overall market was driven primarily by the Federal Reserve pumping a ton of money.
In the U.S.
The entire world was affected by it, which brought a lot of volatility to the currency markets. And since this stopped, and the currency markets have volatility has grown dramatically. How you perform?
Yeah.
And as that I'm seeing, there's basically at the very end of it, just a flat line.
There were 2 years by which foreign exchange was very, very volatile. It's in 08 and 2011. These years we had actually handsome returns relative to the benchmarks. For the most time, beyond these 2 years, the volatility was pretty much the same. And again, the idea is that you can extend your profitability by leverage if you are in a non-volatile environment. It's basically up to the human discretion how to apply the technology. What we care in these type of demonstrations is really not how much money you made. It's really how many times you were right versus wrong in your decision. Because we really leave the final decision on how to apply it to a true profit to our hedge fund clients. This is not our space. We are just the technology providers. Yeah, but that's a good observation. There are times by which foreign exchange will bring you great risk but great returns. In others, it will not be. But we want to make sure we are more right than wrong in our decisions. Unless you want to add something else, Tucker.
Yeah. The one thing to keep in mind is we're not picking a single set of factors and thresholds that we use across all this time. Each week we're reevaluating which factors to use. So in some sense, the strategy that it was following in 2008 may be completely different than what it's actually using now in terms of the factors that are using. Yes, even though the conditions were much different than back then, we're using different factors now. Anyways, I understand your question, and we've discovered, in fact, that yeah, you have to be. What we're backtesting really isn't just a single set of factors. We're backtesting a method of choosing factors. You see what I'm saying? Okay. Well, after we can have a beer and tell you more.
Tell you more about it. Let me just show you one more slide. I'm going to stop for questions and answers. I'll have Dr. Balch come and join me here on the podium. This is kind of a post-mortem analysis of our backtest to see how robust it is, which is very important to do in any research, to see how robust your outcome is. You do cross-validation and you do a robustness check. What you see here is the average participation of a currency in a decision that was in a decision that came from the engine. So you can see here that how many times a security or a currency was one of the long positions that was recommended over that 8-year period, the backtest period. How many times the currencies were recommended on the short position. Now, if they were all the same, flat on both sides, I'll be concerned because that tells me there's no information. It's pretty evenly, randomly distributed. There's no information to exploit here. But there are really two encouraging pieces of information here. Number one, they're all participating one time or another to certain levels. And those inefficiencies, those gaps between participations is what allows us to exploit the profitability of the strategy. So just one thing that we want to share with you, how our quants look at data and visualizing some of the outcomes to make informed decisions about the quality of the strategy. Okay, I'm going to stop here and give you a chance to ask some more questions if you have any. Not just about foreign exchange, but anything else we do at Lucena or anything about the machine learning approaches that we take in our day-to-day operations. Yes?
So, Dr. Balch, in your Udacity course, you've spoken about the reinforcement learning and learning algorithm being a part of the course. I assume that feeding all these 450 features and as states and let the machine kind of figure out what to do. I mean, have you tried that? Have you tried this approach in your thing? And what was the,
let me repeat the question for the microphone here. And for those of you who don't know, I teach a course on Udacity about this stuff. In fact, it's part of a online master's degree at Georgia Tech. So you can actually get college credit taking my course. Anyways, the courses are really good. I'll say that. Did you think it was? Okay, all right, there we go. One strong endorsement. Okay, anyways. What he asked was, so in this course, the last project for the students is to build a trader using reinforcement learning. And that's, there's these broad categories. We talked about supervised learning, unsupervised learning, and there's yet another, certainly even more, but reinforcement learning. And reinforcement learning is a different type, and what you look for is if I take an action, what's my future reward? So instead of making a prediction about a stock movement, you decide which action to take, and you see how rewarding that is. And so I think your question was, if that's so great, how come we're not using it here? Okay. So it's part of what we're doing at Lucena. It's not yet ready for prime time, but I believe that particular set of algorithms, reinforcement algorithms, are really a match made in heaven for trading, because the problem that reinforcement learning is trying to solve is to maximize return. And the problem that we're trying to solve in trading is to maximize return. These other learning methods are actually trying to solve slightly different problems, and we're trying to wedge them into trading, and they don't always fit exactly right. So it's a set of work we've begun. I don't know the answer yet, but we're real excited to try that going forward.
And is there any component of deep learning also involved in it, or you plan to incorporate that in your research?
Sure. Yeah. So deep learning, I don't know. 10 years ago, the buzzword was HMMs. Now it's deep learning, which is fine. Deep learning really works, which is great. But deep learning is in some sense a black box that solves either the classification problem or the regression problem. And so, yes, we're within our overall system, we're able to plug in different algorithms there. We haven't plugged in deep learning yet, but I'm eager to try that. But again, that's you may be familiar with the Google system that beat the world champion in Go. That used deep learning and reinforcement learning. And it used the deep learning really for classifying the board situation, but reinforcement learning for deciding what action should happen. So anyways, I think both of those approaches are important, and we don't yet use them, but it's on our roadmap.
Yes, Derek.
So you said that you were adjusting the strategy kind of on a weekly basis. How do you make sure that the backtest still represents the outcome of the strategy?
Sure. Let me take that, and you can maybe supplement. So here's what we do. In backtest as well as in strategy. So basically, the backtest behavior drives the live strategy. It's the same code base, just on a forward-looking basis as opposed to going back in time. So the code base is very much the same. But here's what actually happens. We evaluate the constituents every 21 days, actually. And the reason we do it for 21 days, we tested, again, multiple periods by which you should evaluate which one works. We even tried optimizing every day. Essentially, try to create a brand new event scan every day using the same technology, going back today, 3 months, optimizing with the macroeconomic factors, and going to the last month and further honing in with technical factors, and then moving forward. And we found out that 21 days was the best. It used to be a week. Tucker is right. We actually modified it recently to 21 days. Again, through lots and lots of back testing and simulations and robustness and cross-validation, we found that 21 days was the optimal time, maybe because of option expiration date. We're not sure why. We don't necessarily need to explain why. The data just tells us what it tells us. This is how we rely on our information. Okay. Any other questions? Yes.
So maybe slightly unrelated. When you're creating a strategy, maybe not for Forex, but something equities related, most strategies are going to have some kind of a drawdown period that you're accounting for. Let's say a strategy passes all your tests, back tests, forward tests, out of sample, and you start live trading. At what point do you give up? Let's say you have a dud, and you may be in a drawdown immediately, but how far do you go until you call it a dud? I mean, what parameters are typically used to calculate that?
So it's a tough question because in some sense, you might have some numbers that help tell you this, but kind of in the end, it's a gut check, right? But there are two tests that we do. One is we look at the mean and standard deviation of daily returns in back testing, and then we at some point we switch over to forward testing, and we can say this is what it looked like in back testing. We can just take the standard deviation and mean and project it into the future, and that gives us some simple guideline. This might be -1 standard deviation. If our strategy is going like that, we're not worried. But when we start seeing this happen, that's a problem. That's one answer. Another answer, by the way, for the statisticians is the Kolmogorov-Smirnov test. Basically, you can feed it two sets of data, and it'll tell you what probability is it that they're drawn from the same distribution. So you grab these samples, and you grab these historical samples, and if they're drawn from the same distribution, that means that whatever's happening over here is reasonably, is not out of line with what's happening over here. But if it says that they're likely drawn from different distributions, then that's another situation to be concerned.
So is this how you trail your stops?
Oh, you mean how do we decide our stop gains and stop losses? No. So actually, Erez and I are often debating about this. In almost every situation, adding stop loss orders reduces return.
But it increases, but the risk control.
Sure.
Especially in Forex.
Yeah. So there are often, so that's on Erez's side.
That's my side of the argument, obviously.
Typically, what we see is as we increase or clamp down with stop gains and stop losses, we see a reduction in return, but an increase in Sharpe ratio. So I'm now a convert to stop losses and stop gains. But anyways, as to how we discover what they ought to be, it's part of that iterative testing. We actually test many different stop loss and stop gain levels. And by the way, we
For the initial, decision, are you saying you haven't figured out how to predict the range for this particular pair would be for the stop loss, but once it starts moving, do you trail the stop?
We do simulate. Sorry, we simulate trailing stop losses and target gains that are not trail. We just do a percentage or limit order from the entry price, and we do try multiple permutations of ranges of potential stop loss and target gains until we come up with one that's a winner. Now, important thing to remember when you do that kind of research, when you start looking at multiple parameters that are sequentially going higher along a range, you want to make sure that you have some sort of a robustness kind of testing to make sure that the values increase sequentially till you get to a pivotal point, and then it starts to decrease, as opposed to you have a lot of noise and one time you got some great results, because that could be an overfitting problem and you stumbled by chance on something that was successful. It's not reproducible.
Another way to say that is, let's suppose this is the parameter you're fiddling with, and this is the the quality of the result. If you've got something that looks kind of like this, and you didn't really look at this chart, you might say, oh, okay, that's the value I should use. But it's questionable because this almost looks like noise. However, if you have something that looks like that, I'm much more comfortable saying, okay, that's a reasonable value to use because it's changing smoothly. And this would be an example of overfitting. This is an example, well, less likely to be overfitting if you choose it in that way.
There's one question here.
Okay, so you've described different ways in which you try to confirm the robustness of the out-of-sample performance. And another way that I haven't heard you talk about is to withhold yet another data set. And that has the advantage of not building in the bias of having selected the rules that perform well in your previous outer sample, but that becomes an integral part of your selection process. So holding out yet another one can help confirm the true robustness, but also introduces another problem of increasing the lag from the time at which you created the rules. So I'm just wondering if you've explored that and what your observations were.
Yeah, so actually I drew this additional line here in anticipation of the question.
The question.
So our typical approach is we choose some period in history that we essentially allow ourselves to overfit. And we iterate and iterate and iterate until we find something that works well. We don't peak here. Once we've got something that works well here, then we'll allow it to go forward and see how well it works there. If it doesn't, then we dump it. And we try again. Now we're still somewhat subject to overfitting because eventually, even if by random chance, one of them is going to work over this period. And that's the reason for this additional filter of forward testing. So we've got in-sample testing, then out-of-sample testing, and then if everything works, paper trading. And we can't have years of paper trading before actual investing, but having at least a few months gives you some confidence that it's then going to work going forward.
If I may just add one thing about this is a very important subject. How do you know you're not overfitting? You didn't stumble upon something just by accident, and you rely on that, and you start trading, and things don't come true. We can change a lot of parameters that are not necessarily impactful or relevant to the strategy itself. For example, when you start with a 21-day, if you start on Tuesday or Monday, should not really make a big difference in the results of your strategy. So we try to do what we call cross-validation and robustness testing by modifying parameters that are not necessarily critical to the strategy, and we see that we can get similar results. And that's one other way of validating that you're not overfitting.
Yeah.
In a lot of machine learning models, there are techniques to regularize the model to introduce more bias and make it more generalizable. Are there similar applications in strategy like that have that kind of flavor?
Yeah. Well, so one thing we do is in terms of looking at our data. I mentioned it earlier. Instead of just using directly the values of the features, we use ranking, and that's a kind of regularization that we've found to be actually really effective. So one take home that I would give folks is look at using ranking as opposed to just raw feature values. Even if you normalize those raw feature values, it turns out still not to be as good as using ranking.
Are we going to talk about Z-scoring and some of the things that we do?
Yeah, that's that one sucks.
Okay.
Erez mentioned Z-scoring, which is a kind of normalization or regularization. And I was just joking. That is way better than just using the numbers directly. And then ranking seems to even be a little bit better than Z-scoring.
I have a question. It's something else. It's, you're not a high-frequency trader, so it doesn't really, but where do you get your data feed, and whether do you verify the quality of the data, and do you provide, do you test against different things?
Yeah, so we actually have 12 separate data providers. Some of them are very mundane, core, price volume data, fundamental data, corporate action data, social media sentiment data, newsfeed data. We're now having additional providers with insider buying and selling transaction information and how they score the relevancy to the price change of the stock. We have discussions with GPS location aggregation company that provides how many cell phone users are in any square mile in the U.S. any given time, and see seasonality of changes of population activity in different regions real time. These are all predictive data, and what we do is we actually have built a fairly smooth and easy process to consume the data, normalize it, and evaluate it on its own merit, whether it's predictive. But the magic really happens when you combine those factors that you just injected together with other factors that are completely unrelated, orthogonal to that data source, and really seeing how they can support each other to a higher level of predictability.
Well, my question was more like for the foreign exchange, for example, do you use one broker dealer, and where for your back testing when you
Good.
getting
Yes.
the trading?
So we don't trade. We don't actively manage money. We don't use broker dealers. We actually build our own brokerage simulation technology that simulates a true broker dealer, and we get the data from Xignite, a neighbor here in Palo Alto, that basically provides the pairs, spot and carry trades throughout the day, and that's what we use.
We have compared that historical data with another provider. Now, keep in mind we're using daily data, not intraday data, but theirs has matched well with another provider.
Yeah, just to make sure we use daily data, end of day data historically, but with the trade executions and the stop loss simulation and the target gain are done with spot trades throughout the day, so we get really tick data throughout the day as well.
Yeah, one other thing, Forex goes 24/5.5, I guess. We selected, I forgot exactly which time it is, but there's a sort of a settlement time in London. I think it's 3 p.m. London time. Anyways, we've chosen that as the end of the day and the beginning of the next day, so that's how we do the daily cycle.
Right.
Is this platform available for small traders, or is it only for heavy duty hedge funds and stuff?
Yeah, we can talk to you about it later. Just send us an email. We'll see if we can help you. It's really meant for institutional investors. It's a little pricey from that perspective, but we can talk about these things offline. Question right there.
Seems like a very great platform to use, very comprehensive. I was curious about how your system handles price levels in terms of support resistance for using for entry and exit levels. Basically, the stock's really very clear. How do you determine where the price level is, but usually not a specific level?
So if I get your question, you're asking how do we simulate the actual traded price of the constituents of the portfolio, or the decision by which we made the price decision, if it's a price volume, for example?
No, not really. Well, so a lot of traders use price as their entry and exit signals.
Sure.
Right? So, a level that has become significant in the past, in terms of increased volume,
Yeah, I think I know what he's getting at.
resistance, the value.
Sure. Sure.
So I was just wondering, how do you factor that into your algorithm and your system? How does it deal with that in terms of?
So the way we address that is we look at. So by the way, what he's talking about is a technical analysis method. It's something like, if the price is going up like this, you might, technical analysts would say that's a resistance level. You know, it gets close to it and then doesn't quite punch through it. Anyways, for technical indicators like this, we develop a way to turn it into a number. And here's an example of a way we might turn that into a number. We have some automated method of saying, okay, that's my support level, that's my resistance level, and then we'll convert it into some number between 0 and 1, depending on where the price is in between there. So then suddenly it's just a factor, it's a quantitative factor that we can feed in like all of our other factors. Does that answer your question? One thing I have noticed about the guys on whatever that channel is where they draw all these technical stuff is you can never pin them down. They can't turn it into an actual reliable method of doing it the same every time. Anyways, long story short, if someone can describe for me a way to turn the sort of art of drawing these lines into a quantitative methodology, then we can turn it into a factor. And we've done that for many, many factors. We haven't done it for support and resistance. What, did I offend people? Sorry. Okay. Okay, sure. As long as we can follow step by step. Draw this line here, draw that line there, and we can convert it into a number. We can use it. We can use it as a factor. We do not use support and resistance currently as one of our factors, but I think it would be actually a very useful factor. My sense is
We're running a little bit behind.
yeah, maybe
on
we
time.
take just 2 more questions and then wrap it up.
Sorry, I'm like taking over and asking so many questions.
Good questions.
My question is kind of going back to the data feed a little bit. Do you use the real time, like as in-memory analytics for the, for like understanding the price action, therefore understanding for example, like the Spark and Kafka?
Right. So we're not in the high frequency trading. We're low latency type of decisions. So everything we do is really happening off trading time at night. We have a very robust process that goes on the weekends, for example, for 18 hours or so, using a genetic algorithm to identify which factors out of the 450 will be most suitable for our KNN method for our forecaster, which is nothing we covered in this strategy. At nighttime, we aggregate end-of-day data, and we recalculate the features, those numbers that Tucker was just talking about, that can quantify a value of any of these features as it relates to a given stock. And that's really what happens. And we use those factors throughout the day for entry, because if you define, for example, a scan that has certain factors with min-max values based on last night's analysis, the next morning, 9:30 a.m., the market opens Eastern time, you are able to apply that knowledge and see which stocks come on the radar, and you can enter them intraday if you need to.
Kind of on the heels of this support and resistance question, not quite technical indicator, but the whole theme these days of volume, momentum, and vastness, and that type of way of assessing data that isn't necessarily a technical indicator. Do you look at momentum and channels, if not support or resistance, but in some way use price and volume data? That's just kind of what a traditional visual trader would do.
No.
Doing all the price and volume and
Oh, we certainly use those factors, but so one price by itself, just alone is not really a good indicator, because it means that if you have data, say on Google, when it's always between $500 and $600, that means that data can't be used for a stock that's trading between $20 and $30, right? Because when you go to look up similar situations in your database, those two stocks' prices never overlap, so you wouldn't use it. So you always have to create some sort of derived number, not price directly, But as one example that we use a lot, I'm running out of board space here. Say this is the price over time, and say this is a 20-day average. You look at the moving average. You look at the ratio between those two numbers, and suddenly that's a factor that you can generalize across many stocks. So we and volume and so on. For instance, you don't want to compare the volume of Apple to the volume of I don't know, some small stock because they're just way in different leagues. But you want to look at change in volume. So if suddenly today volume's gone up 2x for any stock, could be Apple, could be some other stock, that's an important event. Not just that the volume was 1 million. It's more interesting that it's gone from 1 million to 2 million.
Right. So in a way, what you see visually can very well be represented by some of our factors, but we look at the exact numbers opposed to how does it look. It has to be quantitative representation of the value. So how far above the moving average are you? How far below the moving average are you? What is the rate of change? What is the how do you rank rate of change against your peers in your group and the likes? That's kind of where we find the most value from that information.
So you would try to generalize a whole universe of pairs or stocks versus just say having like agent software that could just really just look at one stock or index or pair.
Yeah. So folks, a question that comes up a lot is, do you build a model for each stock and then trade with regard to that? Or, well, the answer is no, because here's why. It turns out that if you build a model for a single stock over 3 months, you've only got 60 data points. And that's not enough to build a statistically significant model. So, okay, you got to go back years, right, before you have enough data points. Well, it turns out that 3 years ago, the market was just behaving differently. It was in a totally different regime. 3 years ago, there wasn't concern that interest rates were going to rise. And so stocks behaved differently 3 years ago. So, okay, we can't build a model for one stock on 3 years of data. We can't build it on 3 months. What can we do? Well, what we do is we build a model using all the S&P 500 over, say, 3 months. So now suddenly we have 500 times more data, and we have to cross our fingers that it generalizes across the different stocks in the S&P 500.
And we do find sometimes highly correlated subgroups within the S&P 500 to find higher correlation, but still multiple data points, as Tucker said, to get that significance historically speaking.
But why don't we break and get a beer and
we'll be around here for more questions.
Please come up and ask your questions. But thanks very much.
Thank you very much.